We're going to go through implied volatility. Implied volatility plays a huge part in your options trading and how your premium is priced. So let's go ahead and go through that. Implied volatility, otherwise known as IV. So what IV is basically it's kind of a projection of how much and how fast your stock is predicted to move or is likely to move in its price. It's not going to predict the direction that it's going to make that move. It's just predicting how fast, how soon it's going to make that move or not. It plays a huge part. Like we went through theta yesterday. Last week we stated that theta plays a huge part in how your premium is priced. IV plays an even bigger part in how your premium is priced. So all of these factors contribute to your premium price. So make sure you understand how IV works. So when it comes to IV, usually IV fluctuates based off of news. So underlying news, upcoming rumors, earnings, court decisions, whatever the case may be, any news or catalyst that could potentially is rumored for the stock or upcoming on the stock, it's going to fluctuate your premium. The IV is going to be a little bit higher. So you'll see stocks, for example, Netflix earnings. Netflix before earnings, IV was a lot lower as compared to right before its earnings. IV was a little bit higher. You could tell that Netflix's premiums were kind of jacked up. So if you pay attention to its earnings seasons right now, so if you pay attention to these stocks and how their IV is currently, and then the week before earnings, you'll see that their IV tends to be a lot higher. And because of that, their premium prices tend to be higher as well. Another thing that you should pay attention to is usually IV is increasing in bearish markets and decreases in bullish markets, basically directly influenced by supply and demand. So if the demand for a stock is high, your IV is going to be high, your premium prices are going to be higher. Demand for a stock is lower, IV is going to be lower. The premium prices are not going to be as expensive. Another thing that you should also understand is that once that news or rumor or whatever thing comes out, that catalyst is finalized, IV usually gets crushed. What that means is, for example, looking to play a stock during earnings, you'll notice that IV for earnings is really high. Premium prices are high, but once that earnings comes out, whether it's good or bad, IV drops. IV drops, and for the most part, those premium prices drop too, unless it's a huge move on that stock. So you really want to pay attention to that as well, because if you try to play through earnings, and this is why I recommend never playing through earnings because of implied volatility, because the fluctuation of the price is so great, the IV moves in such a great percentage, especially if they beat or lose on earnings, you'll definitely see some movement. And because of that IV fluctuation, it crushes your premium if the stock isn't able to beat earnings, or even if they are able to beat earnings and it moves too much throughout that week. So if you're looking to play earnings on a stock, don't play the same week. I don't recommend playing earnings anyways because it's a gamble, but if you are looking to play earnings on a stock, definitely buy a couple weeks out so that IV doesn't affect your premium price as much towards the end of its expiration date. A lot of people always ask me with implied volatility is what is a good implied volatility percentage? There's no set answer for that. Every stock has a different percentage implied volatility, different kind of average. So for example, Netflix kind of has an average of around 30, 35, 40%, whereas Tesla has an average of around 80, 75%. So there's no really set percentage on what a good IV is. You really want to pay attention to the stocks that you're watching, and then pay attention to how their IV is prior to any news, prior to any earnings, and then before that earnings or rumors coming out or product releases. Pay attention to how that IV increases, because 90% of the time that IV is going to increase whenever there's earnings, and you'll see greater premium prices on that stock. So for example, Tesla has earnings coming up, Amazon has earnings coming up. You'll start to see that their premium prices are extremely high right before their earnings report, and that's due to that IV percentage increase, because people are anticipating that the price of that stock is either going to increase or decrease in a shorter period of time because of that earnings report. So IV is extremely important. Make sure that you guys understand it. It does take time. Obviously, I'm not going to go through the equation for IV because it's a really complicated equation, but it does have to do with one standard deviation, which calculates the range in which the stock is going to move in a specific time frame. So I wouldn't worry about that. Just pay attention to pre-earnings, post-earnings, pre-news, rumors, and how your IV is going to affect your premium price, because that is what you want to pay attention to when you're trading options.
Excellent. I think we have a great question here from the viewers. One of the things we'd like to do at Options options advantages. Definitely get questions from the viewers here on the education especially. So we have a question here. What would you consider too low of an IV for an options trade?
So under 30%, I think is too low. If you pay attention to some of the stocks with really low IV, they have really low volume, your premium price is not going to fluctuate as much. And even if the underlying stock does move, because the IV is so low, your premium price is not going to fluctuate as much with it. So below 30%, again, depending on the stock, but below 30%, I would say.
Perfect. And just to kind of counteract that, what would be maybe like an extreme IV on the
So
opposite side?
like I said, it really depends on the stock. But for example, Tesla, I've seen IVs of over 100%. Anything over that, I think, is really, really high. For stocks like Apple or Microsoft, anything over probably 50, 60% is considered high for those stocks. So it really depends on the stock. The higher volatility the stock, higher IV. Lower volatility stock, going to be lower by IV.